The economic outlook for next year continues to trend positively, but still with a complicated, uneven global backdrop. A quick update of our forecasts and the latest developments for the markets. The rapid increase in vaccination rates has brought forward the easing of COVID restrictions, bringing forward spending and mobility well ahead of year end. As a result, the rebound from the Delta second wave will be earlier and, measured by GDP, is expected to be a sharper recovery than previously forecast. As the chart shows, the second dip caused by the Delta strain was sharp, but much shallower than last year's recession. So, with borders reopening, our economy is now well positioned for the expected upswing. GDP growth in the fourth quarter of this year and through 2022 should mirror the V-shaped recovery of last financial year, as should jobs growth, with unemployment potentially falling below 4% next year, its lowest level since the 70s, driven by record high levels of job vacancies and national demand for labour. Retail sales fell 4.5% in the September quarter as discretionary spending took a breather, with New South Wales, ACT and Victoria in protracted lockdowns. But from here, consumption is expected to accelerate. This will be driven by elevated levels of household savings and disposable income, all helped by record low interest rates and extraordinary levels of fiscal support. That all suggests that demand won't be the problem in the months ahead, and, as we mentioned in last month's report, accrued stimulus will be deployed amid rising consumer confidence. But while demand looks strong, the supply side is more challenging, be that via supply chain bottlenecks, elevated freight costs and energy costs around the world, and also labour supply. The combination of high demand but struggling supply has an obvious consequence: rising inflationary risks, and so rising interest rates as central banks try to walk the fine line of creating enough inflation to meet their targets, but not excessive inflation. The financial markets have continued to respond to this reality by pricing in higher official interest rates next year, pushing up our bond yields and swap rates about 1%, despite the Reserve Bank of Australia still insisting that rate hikes aren't likely until around 2024. As we've suggested for much of this year, we see late 2022 to early 23 RBA rate hikes as a timing more consistent with these inflationary risks. And that scenario can be hand in hand with economic growth, jobs growth, but most importantly with wages growth. So the outlook for the economy is promising as we come out of the double-dip pandemic era, but complicated by inflationary risks, normalising interest rates, and the uneven impact of COVID-19 on businesses and locations. And lastly, stock markets are back at record highs in the US and Europe, although lagging a little here. But business confidence rose resiliently in the latest survey, matching Australian consumer sentiment, and also hopefully matching high levels of demand in the months ahead. And that's the market update from Bendigo Bank.